And so we started the process and we started the diligence process. And then the first red flag that came up was there was a delay in sending the diligence. Now, if anyone's in M&A, we know that that's pretty normal, right? If there's delays. The challenge was that we were on a super compressed timeline. And I think the initial timeline was 3 weeks to close. And, I wouldn't even say we did like a true formal LOI. I think we did like a very light version of an LOI, pretty basic terms. Second red flag that came up was we were still pushing on what we needed in the diligence process. And there was a refusal on a specific diligence item. And we got to a point where we were in the timeline of like, we needed to buy this company in a week. Otherwise, this company could go under.
You have found the Business Broker Growth Show with your host, Jason Cutter. This is the podcast for brokers who are ready to stop hoping for deals and start growing their pipeline. Our goal is to bring you strategies, stories, and insights that will be a catalyst to move you quickly from transactional deal makers to trusted advisors. Time for Business Broker Growth.
Hey everybody, here with the after show with Ayelet Shipley. She is from Liquidity Studio. Hopefully you checked out part 1. Ayelet, are you ready for the after show for part 2?
I'm ready.
All right, let's do this. So in the first part, we talked about all things brokerage and business and your kind of pathway here. Then we talked about some marketing growth tips, which were amazing. I really love the things that you mentioned, like basically owning the room and hosting parties and doing the things. Like, it was fascinating because it was things that most guests don't say on the show. So I love that you had like a different approach on what you found work. And where we left off is the deal that got away. So this is the lessons of the lost deal. This is one of my favorite parts because I think there's a lot of gems that come into this. I would say if I surveyed most guests, this is probably their least favorite part of being on the show, is having to share this, because I know it's not fun stuff. But I know that you've got a different take on this. You've got something. Each time we've talked about it, you're like, oh yeah, don't worry, I've got something to share. So let's dive into that. What's the deal that got away?
Yes.
Quotes for you.
So this is, the deal that actually didn't get away, but should have.
Okay.
So let me just start from the top of it. And yes, you're right. It is my least favorite part talking about this because, it's hard to recall these things. So this was towards the beginning of when I actually got into M&A. So I was starting at the associate level. I was on the buy side. So I was at a firm that was doing the buying. So we were an aggregator. And we had a very programmatic process for acquiring companies, like truly programmatic processes and gates and systems and frameworks and investment committees and at what stage. And we were sitting in an M&A team meeting. And this was, from the very top down to like junior associate level. And, one of the key stakeholders in the company, it was one of 3, said, we have a deal that just came in. It didn't come through our normal channels. And we really want to move on it. And it was like, okay, well, let's take a step back for a second. Let's understand it, because we are very entrepreneurial still. You don't want to pass up on an opportunity. Are we still going to run the normal process on it? And, the answer from the key stakeholder was, yes, we are still going to run our normal diligence process and investment committee meetings. We are just going to do it in a compressed timeline, because what's going on right now is the seller is pretty much on fire. Now, it's not a turnaround, but they have a killer sales system. They have tons of leads. They have an incredible marketing team and sales team, but their fulfillment is what's on fire. And so they're so backed up from a capacity standpoint, and the founder is overwhelmed and, just kind of done. And so we want to take it over. And so I said, okay. And so we started the process and we started the diligence process. And then the first red flag that came up was there was a delay in sending the diligence. Now, if anyone's in M&A, we know that that's pretty normal, right? If there's delays. The challenge was that we were on a super compressed timeline. And I think the initial timeline was 3 weeks to close. And, I wouldn't even say we did like a true formal LOI. I think we did like a very light version of an LOI, pretty basic terms. And so we had to diligence and negotiate all at the same time. And there was a delay, and seller said, I'm just on fire. Sorry for the delay, kept going. Second red flag that came up was we were still pushing on what we needed in the diligence process. And there was a refusal on a specific diligence item. Now, I can't get into as many details, but it was enabling us to really check out this leadership team. And we got to a point where we were in the timeline of we needed to buy this company in a week. Otherwise, this company could go under.
Wow.
Yes. And so typically we have an investment committee meeting. And I wasn't in that at the time because I'm at the associate level. And so the investment committee makes the final go, no-go decisions. And I guess what happened in that meeting was, the two key stakeholders in the company who, one was the CEO, the other was in charge of M&A, along with the director of M&A, and then a few other, C-suite team members. They said, okay, we're gonna make a decision together. Key stakeholders said, listen, I'm not going to go forward with this deal if you guys aren't in alignment. I know that we couldn't run the normal process. Based off of what I see, even if the company were to blow up, in a sense, if we could recoup the investment by just taking over the marketing and the sales, would it make sense for us to do the deal? And everyone said yes. And they said, okay, regardless of the fact that we didn't get the proper diligence, we specifically didn't complete one item, and we don't really have that big of an idea of what's going on. By the way, this was a warm introduction. And so there was a level of, in the industry, people, and you can kind of discern what's going on. And the key stakeholders felt comfortable enough with that. And then everyone agreed. And so we went forward on the deal. Now, I said to everyone in another team meeting, I said, I think it's insane that we're going to go and close on this deal. And I think it's a terrible idea. So I will just put that one out there. And I'm still very close with the key stakeholders today. And what ended up happening was we closed on a deal. And the why I say it's the one that got away is because what happened? What happened was post-close, one, there were some shady things that we found. Two, the fulfillment that we thought was on fire. So our entire operations team, our leadership team, the fulfillment of our other portfolio companies, were all focused for 2 months on trying to save customers dealing with client complaints. Now, we were totally protected from a legal side. Liability wise, it wasn't a liability issue, but our team's focus went all in on that. The company was losing money. Our company was putting money in. Now, the structure of the deal was actually pretty low risk from us, in the sense that it was all deferred payments. It was, the only closing payment I think was a few $100,000, but then we were losing a few $100,000 more. But if you look at it in grand total, maybe $600K. That's not why I think that the deal should have gotten away. It's that what happened was our team's processes and systems were in place for a reason. And what happened when we didn't follow those systems and those processes, and there was a decision made at the top that not necessarily all of the other levels of management and team members were rallied around, there creates a gap in trust and alignment. And so focus, trust, alignment really set the team back for a good number of months. And so that is why I feel like it was the deal that should have gotten away, because it was a dumpster fire. And, sure, we lost a little over $500,000. That wasn't the end of the day. It was, once you create a gap in alignment and trust and, focus with your team, I think that's where you really lose.
Yeah, and it makes sense, and I've seen that before, where some initiative takes priority that's outside the parameters of what's normally done. So it's an exceptionary kind of process or deal or something, and then all hands on deck. Then the alignment is out. People start questioning the decision to do that process, why there's the structure and
why was there the structure in the first place?
Yeah. And then what happens, like you said, is that now there's maybe a lower level of trust. Like, why are we doing this? And did this even happen? And then what I also see is because, like in this case here, you're 2 months of everyone focusing on this. What's not getting done over here that becomes the next fire that didn't need to be a fire because the
or what
process was
opportunity
broken.
did we push to the side from a really great potential acquisition because we were so focused on that. And so it's not only like the cost that it actually, had on us, on the team and on, the financials, but then what was the opportunity cost that was lost?
Yeah. And I've seen this within a few organizations, like a corporate level, where CEO just wants to do deals or say yes to everything. And just basically generates exceptions all over the place that then becomes this like fire drill of exception making, which then that's all it becomes.
Yeah. And I wouldn't say that like this was that. Like, I don't think that the CEO did that at all.
Just a one-off.
I mean, I think that leadership in general was entrepreneurs, right? And entrepreneurs have, shiny object syndrome, and, we get distracted and they love the fire, right? You love the grind. That's why entrepreneurs are who they are. But it's a really hard balance when you're an entrepreneur within a scaled organization and leading a scaled organization, in discerning. And I would say the CEO is highly experienced and incredible, and so is able to say no to a lot. This was just one that, everyone really learned their lesson the hard way. They're going to move forward with and do in the future.
Yeah. And I think that one of the biggest takeaways is, the processes are there, the red flags and things popped up that were indicators that things were not going the way that they should go based on a process. And one of the lessons, I think, especially for business brokers listening to this, and I know this has come up many times, which is when they see red flags, let's say from a business owner, seller that they're starting to work with, and they ignore those red flags and take that client on or that buyer on or whatever that might be. And like, you have a process, you have rules for a reason, and then you violate that, it generally doesn't work out well.
Yeah. Yeah. It's not about always getting the client. It's about having the right client that's right for you, and then what you can handle. By the way, there are some people that are incredible at turnarounds, and that's what they specialize in. And that's what they're as brokers and as advisors, they go and represent those. And that makes perfect sense. But that's their expertise. That comes back to what we talked about on part one of like vertical expertise and industry and, type of client. There is a particular advisor and broker for that.
And if it's not yours, don't try to make a square peg fit into the round hole.
Yeah, don't trick yourself.
Because you're going to pay for it. Yeah. All right. Well, now that we got that covered and out of the way, let's talk about some fun and different topics, the general after show stuff. Now that I put you through that to start off part two.
Great morning start for that.
Yeah. So let's talk about some of the other things. So one part, and we kind of briefly threw this out there in part one, but didn't really dive into it. And I wanted to talk more into it, is that you have the podcast that you started, right? And that you co-host. Let's talk about that, because I think it's fascinating and fun. It feels different, but similar. It's like, it's something you're doing and it's like adjacent, I guess. So talk about like how the show came about, what it's about, and who it's really for.
Yeah. So I actually didn't even start the podcast myself. So my co-host, Christian Hassold, who has been in M&A, he was, former operator. Then he, ran M&A functions inside multiple private equity groups, most recently, one of the largest private equity backed agencies in the country. He started this podcast because he was getting tons of inbound from, sellers being like, hey, how does this M&A process work? All of the things. And then his, the C-suite of the private equity group was saying to him, like, how does this actually work inside of this specific industry and vertical? And he was getting really sick of pushback and all of the things. And he said, why, and I've seen this too. We've been saying, like, why is M&A treated like a black box? And why is there, less insight into what's actually happening from the nitty gritty? Why are people trying to gatekeep this? And so he originally started the podcast, and, this was probably a year before I came on, and he wanted to co-host from the beginning. And for some reason, he couldn't find the right one. And lo and behold, we got introduced to each other about a year later. I was actually trying to get his business. And we got on a call and he was like, can I interview you on the podcast? You have a really interesting story. And I said, sure, that'd be great. We did one episode, we put it out. I was on the interview and it was double the amount of views. He was like, maybe that was a fluke, right? We don't know the algorithm. He said, can I do a part 2? And I said, sure. Doubled again. And he was like, I love our shtick. I love our banter. How do you view podcasting and kind of like, detailing these things? I was like, this is so up my alley. This is what I do. And so ever since then, we are co-hosts together, 50-50 partners, and we've been growing this thing. We're now a part of a network, and it's called the Inorganic Podcast. And who it is for is actually, we say it's M&A at the intersection of media and commerce. What does that mean? It is marketing agencies, digital transformation, AI companies, tech companies, really that focus though in the marketing, tech, ad tech space. And what we focus on is we speak to 2 different people, well, 3. We speak to the buyers directly, right? Who are the buyers, the investors, who are the potential sellers that are going to be going through a process that, don't really understand what is happening in the deal. What are the terms, the market terms that are happening right now? We cover real deals. We do weekly reports. There's been so much M&A activity. We actually do a weekly report on the deals that have happened in the last week, which is very crazy from a time and production standpoint. And then we talk to the service providers around it. So that is what we do.
I love it. I think it's great. I've checked out episodes, and it's just, you're right. The M&A process, everything that goes into it is very much a black box. There's not a organized system. There's no, let's say, MLS like there is for real estate, where if you're listening to this and thinking, I want this level of authority, I just don't have the time to build it, that's exactly what Business Broker Growth does for you. Most brokers know that they need consistent content, better positioning, and real digital visibility. They just don't have the bandwidth to create it or the systems to keep it going. And that's what we build for you. The content engine, the visibility strategy, and authority signals, everything you need that we've talked about here. So if you want this impact without adding another full-time job to your plate, go to businessbrokergrowth.com to learn more about what it would look like for your business. Now, back to the episode. Like there is for real estate, where you can see transactions, there's details, things are, closely guarded secrets.
But it's also like what's happening, what's being reported and what's not being reported, because a majority of the deals that we touch, 1 might not even be announced, but 2, none of the terms and the price are announced. And I do not talk about my clients and name them and name the price and so on and so forth for those types of episodes at all. But we're able to anonymize, certain deals to a level if we have a lot of inside information too.
Yeah.
Everyone in the industry talks, right? We know what's really going on. And so if we can give sellers really an idea, because it's what we said on like part 1 too, like, if you're doing the barbecue test and you say, I sold my business for $50 million and the person next to you says, I sold my business for 100 million, but it turns out the 100 million only pocketed 10 and the 50 pocketed 45, right? Sellers don't know the different structures and trends and terms that are happening right now, because it changes constantly, and it's changed in the last 12 months significantly.
And I think what's fascinating too about what you talk about on the show and the goal of the show to talk about those parameters, those deals, is that it seems like there's so many different ways that deals can get done and structured, going back to your barbecue test, right? Like the $100 million headline sounds great, unless that person has to stay on for years. And then most of that's tied into, future performance. And then what do they really have? Like you said, like at the end of the day, they walk with 10 versus the other one. And I think there's so many business owner sellers that just don't understand how things can be structured, what they want it to look like and don't want it to look like, and so on.
Yeah, exactly.
Well, that's great. And so, again, it's the Inorganic Podcast. Why that name?
So, I mean, if you think about growth, you have 2 forms of growth. It's organic growth, or you have inorganic, which is M&A, right? And so it's like a cheeky way of saying it. And also sellers identify with the word organic, right? Business owners understand like when you're growing organically, you can grow by X% each year. Inorganic growth, your growth rate can actually be significantly, exponentially larger. And so even the word organic start versus saying, we are the M&A podcast of blah, 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 right? You're going to get less clicks on that one because you identify less with sellers, because a lot of business owners don't identify with saying I'm in M&A at all because they're not in private equity, and that's just the way it rolls.
Yeah. It's interesting. For the longest time, I didn't know the business. I didn't understand it. And when I hear mergers and acquisitions, I think of the movie, The Thomas Crown Affair. And so I just think it's that. So I would probably think the same thing. If I saw an M&A labeled podcast, I would think, okay, well, that's.
Yeah. And also you would think it's really boring usually. Coat and tie and all of the things. And so we also are very approachable, and we have a very different demeanor, the two of us. He, speaks more on he has a more academia, vibe to him. And I have more of this shoot it straight to the cut. And so the balance of, the data and the reasoning and the stories really come together to be very approachable to all the different levels that are in there.
Yeah, I love it. We'll have a link for the show in the show notes to the show itself and ways to find it. I always recommend people check that out because I love it. Again, and I have co-hosted shows in the past, and you find that right co-host, and then the conversation back and forth is just so much more valuable than a solo show. Sometimes even more than a guest show, because you just build this kind of, like you said, the banter, but the rapport and the flow. And you just have this mission, and those are always fun. I really enjoy co-hosted shows.
Yeah. I also really like that we didn't go into it together in the first place and have this like friendship prior. We're super different, and we love each other, and we have just such a great mix. But there is two sides to, the thought process of going into business with friends and with family. And like, I will say I've also been in business with family, and, and then all the friends that all the things. But it is a really nice balance in there to have kind of come to this organically, right? Rather than inorganically.
Then inorganically. I love it. No, it was a organic merger and acquisition, not inorganic.
Inorganic.
I love it. All right. Next question, after show related here. Let's talk about this. So if we think about business broker, M&A, intermediaries, in these categories like we've been talking about, and we forecast 5 years in the future, which is now 2031, which is always wild when I say that. What do you think advisors, intermediaries will need to do to survive in 5 years from now?
So this is the biggest kind of, movement in history that we've ever seen with where technology is going. Like, we genuinely cannot predict what is going to be true in 5 years from now. We have predictions that there will be significantly more transacting online without intermediaries, definitely below 1 million of EBITDA. I mean, that's a no-brainer. People transact at, super low levels online as it is. It's happening more and more with AI and technology. And so advisors and brokers right now, if they are not even, integrating AI into their life right now, those are the ones that will not survive. I think that where we are for the next 3 to 5 years is our vertical and deep industry expertise is what keeps us, from being replaced. And so how do you continue staying at that top 5% of understanding and deep knowledge, the thing that gives us the edge? Because all of the other things are actually going to be replaced. And so your strategic knowledge around it. And so in order to survive that piece of it, you have to really learn how to be utilizing and staying ahead in what's coming, because things change every single week. Like even yesterday, there's been a new shift in AI and, kind of how the different LLMs can interact and be guided together in one platform. And so there's just so much going on that you have to stay on top of it.
Yeah, and I think the what I hear you saying about having the deep industry experience and then being, understanding the strategy of it is that in the complex work that you all do and what business owners, sellers are really looking for is they're looking for the guidance that comes from that experience, not just the information. And I think to your point, the sub $1 million, transactions, that's more transactional. That's more straightforward. A nail salon, a small restaurant, something like that. Like
you can make it
that's a little more formulaic. And then you get above a certain level and it's like, there's not a AI tool that's going to help you do that deal. It's going to take the experience.
But you can also argue on the, nail salon deal that, there is still nuance into it because there is, and people are still involved in that sense. But what the trend that's happened in the past was you look at cars, right? You look at, how you used to go into the lot and test drive and all the things. And because of where the world went, it became transactional. And so we are already starting to see, these very small deals be transactional in nature, and it's just accepted from a market perspective to do it in that sense. And so we're going to continuously move that, I think, up market. But I don't believe, $50 or $100 million deals will be transacting only online in the next 5 years, because the bigger the check you write, the larger the risk, and people are finicky, even though those deals tend to be less hairy than the $1 million deal. But your ability to, have that strategic value and strategic understanding of how people move and irrational actors and behavior and incentives and alignment and the really deep understanding of the business sector, that is where, your value comes in over the next 5 years, really specifically.
So the next question is generally the number one tech shift coming to M&A. We could say it's AI. Outside of AI, what other tech shifts do you see happening?
Tech shifts?
Like technology shifts, the things that are changing the landscape of M&A beyond just the AI, right? Because we touched on that, like other tools and technology.
Yeah, so I mean, if we think about where the world went from even a software perspective, right? So, initially it used to be custom software. Then custom software became significantly too expensive to build. And so that's where SaaS came in, software as a service came in. And so then you had all these specific tools for specific purposes, right? And that was really hot because that was more affordable in a sense. And then, so a lot of us as advisors and in this space, we have a lot of different software platforms that we use. Some people use SharePoint for their VDRs, and then they use different tools here and there, for diligence. We have Kira for diligence, which is also now AI. But what's now happened is it's actually cheaper to build custom software utilizing the AI platforms. And so this is actually what's going to be coming in for all of us, is the ability to have this custom by having, API connectors to all these different other platforms that are specialized. So if we're getting specific, besides AI, I mean, AI for what, right? It's specific diligence tools. Quality of earnings, I think, will be one of the first that is really, it is going to be mostly AI and mostly technology. I think that is one of the easier ones on the M&A level. Financial diligence, legal diligence from an initial level, those are what we're seeing from it, an innovative standpoint. Our preferred legal teams, which is Speed M&A by Jones Brothers, they all use AI in their daily life as it is, and for drafting and initial drafts, and then for looking at contracts across. Why do you only have to diligence your top 10? Now you can actually diligence all 100, and then you can have, we use Kira to be able to pull out specific red flags. We can also connect everything now. So I think that's another technological advance. If you're looking at everyone working in their silos, and this is why Liquidity Studio was created, why does quality of earnings only work in their vertical and then speak to, buyer or seller? Why does legal only speak, in their language and then report back? Operational diligence, advisor, everyone. And so now there's the ability to, orchestrate all of this information and package it in a way that's distributed to the right parties that matter at multiple points in the deal. So that's where like Liquidity Studio is also very heavily focused on, where the technological advances and tools can really help in that distribution and symmetry of information.
I think that makes sense, and I think what you said too about everyone's working in the departments, their silos, kind of their focus, and then bringing it all together and joining it. I mean, what I see as a dysfunction of most companies is that everyone's just in their siloed thing, and it has to go up to go over. And there's
like when you're building a house, right? You have a general contractor usually for a reason, but like your plumber, isn't going to be doing, the plumbing work on the house while the electrician is in the same room. And then not looking at what's kind of behind the wall here. And by the way, I'm like the least handy person, so this might be like in that sense, but they're doing different jobs in a sense, but they can affect each other, because what's going to happen to the structure of the house if we didn't have the understanding of the structure and kind of what's behind the wall, and everyone's just doing their jobs. They could do it right, but how are we going to get the information of what's actually behind the curtain?
Yeah. And if you think about that analogy, right, if the plumber only cares about what the plumber wants to do and isn't mindful of all the other parts that have to go into the wall and how it's all set up, it's going to make a mess for the next person, who's then going to have to adjust. And then it's just going to, go downhill and just become this bigger thing that it didn't have to be as far as an issue. Yeah. And I think it's interesting too, because it's AI, but like you said, it's like how you're using AI. What is AI doing in this evolution on the tech side, which then goes to what you were talking about in the first part of surviving in the next 3 to 5 years, which is then being a broker who has the expertise and the experience and the strategy part, but also using the technology to get everything else done, at scale and at speed, which I think is important.
And clients are expecting, by the way, what used to take you 20 hours to take 3 hours now at most. And they're also expecting you to charge less. So we're coming into a pricing model shift. I know we at Liquidity Studio, our legal team too, we have been really, trying to grasp like value-based billing and trying to perfect it in that sense for a while now. But it is going to become an issue kind of across all of the different service providers in the transaction. Is how are you balancing, the end product that you're still going to get, the time it took, and, how are you marrying that from a billing standpoint? And so clients already expect it to cost less money and take less time. And so you need to know that expectation is here, and how are you going to approach it?
All right. Final question. So it's mid 2026. It's now August, which is also crazy to think. Normally I'd say, what are you excited for the next year? What are you excited for the rest of 2026 and heading into 2027?
I feel like this year has gone by so fast, given, the scaling of our company and the amount of M&A activity that has gone on in the first 6 months. I can't even imagine, how it's going to grow from here, because it has already been so much. But I'm really excited for the next 6 months of M&A. I like looking at shifts and trends, and I like when things go like this a little bit. There is a little bit of a roller coaster. I think that experienced operators and experienced business owners know how to still transact through ups and downs, because they've seen it before. They've seen, you eventually level out. And so those are the ones that survive and, often create best businesses, even in down markets. We're not in a down market in that sense. But I think that there has been a level of a roller coaster. So I'm excited to see what innovation comes out in the next 6 months and how things are changing and how we can take advantage of that with the amount of M&A activity that is happening.
I think that's great. And I think there's always shifts. There's always things going on. It's also always unpredictable. I think for the last 2 years, every January, most people had an idea of how great the year was going to be or how smooth and easier it was going to be. And then each time that has not happened. And so I think you got to embrace that.
Owners, I was going to say how many business owners do you talk to in Q3 where it's like, yeah, it's been a little bit of a tough year, but maybe Q4 will be better. But, here's what our trailing 12 looks like. So I totally understand valuation right now. And then Q1 happens and they have this memory wipe, and they're like, I'm going to double growth this year. And I'm like, but what happened in the last 3 years? And they say, well, but it's Q1. I'm going to have a great year. Like, I'm going to double growth. And we forget.
It's like the Q1 New Year's resolution of like, but it never happens. That we don't plan for that, right? Like, and what would it take to actually put in the effort to do that? If you want to have that kind of growth. So I love it. I'm excited. It feels like there's a lot going on in your space and in transactions and deals, and hopefully that will continue. I mean, it's always going to continue. There'll always be transactions no matter what the market's doing. And I love what you guys have created and what you've got going on. For people tuning in, again, make sure to check out part 1. There was so much in that conversation. We had to move parts of it to this part of the conversation to record here in the part 2. Also, your links will be in the show notes, but they can go to liquiditystudio.com. They can also find you on LinkedIn. And then the podcast link will be in there. I know it's on YouTube with videos regularly. Ayelet, thank you for being here. Thanks for giving more time and energy and wisdom to part 2. I appreciate it. And I know that the audience got a lot from this.
Thanks. It was so fun.
And for everyone tuning in, make sure to check out that part 1. It's so valuable. Make sure to support content like this. Like we've talked about, she and I, there's not enough information out there. It's why that she has her podcast she co-hosts. It's why we do this to help, raise the bar of the awareness information that's out there. And so whatever you can do to support this will just help more people get informed, which will just ultimately help more of the transactions going on. And until next time, stop hoping for deals and start growing your pipeline.